Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast Network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast.
Ozcast.
Simply head to ozcastnetwork.com for details.
Paul Atherton, an ex-Wall Street advisor and finance whiz, and Tim Whiffen, a millennial with a keen interest in complex problems, talk to experts in many different fields to learn and discover the world's economic and political issues. This is Currency Affairs. I'm here this morning with Paul Atherton. How are you, Paul?
Yeah, I'm real well, Tim.
That's good. We've been talking a lot about global economics recently, and I've really taken this interest in China because it's super contentious, right? And
yeah, more contentious now, I suppose, but I think 5-10 years ago there was no contention. It was just China was overtaking the world, right?
That's basically all I've heard for most of my life. You know?
Yeah.
Now, I mean, there are books that I remember borrowing in high school that were written in the late 90s about how China is going to be the next,
Right.
So I've read the figure of 6.5% growth. Most countries, I think, would kill for this GDP. Most countries try and probably synthesize that a little bit. But why do you say that's a bad thing?
Well, it's not that growth is a bad thing. Growth is clearly a good thing. It's my question's not on what I say is that I don't believe the number, and it's not that they're making it up. It's that it's not real GDP growth. So any country can, if they want, print any GDP number they want. It's dead easy. But for most countries, and just trying to unpack that a little bit, for most countries, almost all countries, GDP is a measure of output. And you could argue how well it represents that output. And there is a big debate about that, by the way, too, about actually it doesn't really represent the output very well because it's missing components of the economy. But what worries me about China is that the real growth, what I would call real growth, if we were to equate it to an Australia or the United States, the real growth is significantly less than what they're printing. So they're in, I think it's 6.5% or just under 7%, and that number is, I think, entirely spurious. Now the reason is not because they're lying. I think there's a little bit of that, but not.
So they're not kind of conscious of it, right? It's not.
Well, no. So what it is? So let's take a scenario. Let's call it two economies, China 1 and China 2. Maybe is that a good example? Mm-hmm. Both these Chinas decided to invest in digging a hole into the ground. Mm-hmm. Which we all know would be a waste of time. We wouldn't want to do it. And we say, why are you doing that? That's just a big waste of money. Now, China 1, which is like current China, the way they do it, will get the money to do this through regular channels and dig that hole and spend that money, and it's $1 billion spent. Now, there is zero economic activity out of this. China 2 does the same, but China 2 recognizes the fact at some stage, I don't know if it's instantly or several months, that this is a wasted investment, and it must be then taken to an expense. It must be taken to what finance guys would call being taken to P&L. In other words, it's got to be written off. Okay, so as an L, not a P, right? It's a loss. But so China 2 then, so China 2 goes through the $1 billion investment and then $1 billion write-off. And there's probably other write-offs that go with it because there's friction involved in between this equation. But let's just keep it simple. So we're back to zero. We've done a round trip with China 2. But China 1, the way China currently invests, doesn't write off its debt, doesn't write off bad debt. Okay, so and this is very clear, and I think almost all economists agree that is the case, that there is that China does not do the writing down of non-performing loans, and the fact that it is substantial. I think most economists would agree on that. So what happens? Well, that means the way China measures GDP is measures it as an input, not an output. So Australia, United States measure it as an output. So they, their regular economic activity, and they measure what is coming out of the economy, whereas China is measuring what's going into the economy, and therefore there is no such thing as a bad investment. Every single money thrown at any single project is considered to be positive and is printed to a positive GDP. That quite clearly is not the case. So all investments are not, and this is usually against what most economists like to believe too, fundamentally, that any investment is positive, but it's not true. And certainly in China, that is not true today. So you are now in a position, China is now in a position that 6.5% does not represent true growth. You really have to write off all the non-performing loans to get somewhere even close.
So how, if they're non-performing, how are they able to write that out as growth? How are they able to
it's the way it's held on the balance sheet and the way it's
Okay.
So the way it's represented as an accounting identity.
Like projecting?
No. It's invested.
Okay.
So it's an investment. Okay, so let's say you and I we work for company ABC, and as a company ABC, we invite some potential clients out for dinner.
Mm-hmm.
Okay, so we take them out to dinner and we spend, I don't know, maybe we go to one of your expensive restaurants, Tim, and we spend $500. Is that an expense or an investment? Well, I can...
Oh, that's interesting. I mean, it depends how philosophically you want to look at it, I suppose, but it's probably an expense.
It's an expense. It's an expense. That's right. So we need to write that. It comes out of profit.
Mm-hmm.
So the way that's held, we won't go over too much on the balance sheet and how that's done from an accounting perspective, but the way China holds that as an investment.
Right.
So now that appears as growth. That's the way it is. That's the way GDP will count that.
Okay.
And wow, what a fantastic position to be in, right? So there's no such thing as every penny that's thrown, every dollar that is spent, everything that is spent effectively in this type of accounting structure
is an investment.
It becomes a positive to GDP. Crazy. And so that's why they know with certainty, give or take a very minor amount, what the GDP is. I mean, this shouldn't be a mystery to people or economists. But it is. And it is in the sense that people are impressed, but they shouldn't be impressed at all. It should be very depressing. And why is it depressing? Because the economic incentives are all wrong, right? You need to have a positive... Investments need to have... So you invest today for consumption tomorrow. But with this type of structure, you do invest today because it's worthwhile, because it prints positive GDP. And it's why the West, we do not know what the GDP figures. It prints a GDP, we don't know what the number's going to be. And it wildly swings. It's above expectations, lower expectations. We don't get that from China. We get one print, we know what the number is, they've told us, 12 months what their target is, and it hits it. And we go, wow, aren't they clever? But it's not clever. It's just the way they measure GDP, and it's wrong. Well, it really skews incentives. I should say it's wrong. It skews incentives.
So what I'm hearing then is that China has a lot of debt, and I've heard this from other people as well. So could they reform their system to be more productive, or investing productively?
Let's just connect the dots there. So if everything you spend money, so the other thing is what China's done is, I think most economists will agree that China is an incredibly unbalanced economy. Now, that was a little bit of a debate some time ago, but no one's debating that now because it's so unbalanced, it's almost surreal. And everybody recognizes that we need to rebalance it. So what happens is the household sector has been funding the production or the producer sector, and it's been doing through a number of mechanisms, but one of those mechanisms is very, very low interest rates. At low interest rates compared to what inflation should suggest it should be at. And what that means is that people that are the companies and organizations and the state-owned enterprises that are investing in whether it's real estate or a new construction project or bridges to nowhere or empty airports know that the funding is so cheap, you might as well do it. And then, and at some points, if you look at I don't think this is quite the case now, but it certainly was that in fact, the funding was like being paid. So it was negative real interest rates. In other words, you were paid to do a project. Can you imagine that? Imagine going to the bank and borrowing to build a business, and they gave you money for building it. No, so not only the money for the business, but they gave you extra for free.
Like a grant.
Yeah. So well done. Thanks for turning up. I'll give you some more money. Which is kind of what the structure is. Okay, so now going back 30 years ago, anything, because of the war, because of the communist regime, and just multi-decades of under or no investment. Anything China did was a positive. Anything China state did as an investment project was positive. Positive impacts to GDP. That no longer is the case, and has ceased being the case for a considerable amount of time. And what that means, and again, this is why I think most economists just fundamentally believe as an implicit assumption that all investment is productive. But that is not the case, and it certainly hasn't been the case for China for at least a decade. And so that means, and what I mean by that, is that if you invest in a project, the productivity that comes out of that investment should be more than what you invested in the project. You invest $1 billion, you must get more than $1 billion out of it. If you don't, that means there's debt. And that has been the case rampantly across China, like I said, for at least a decade. So the debt servicing costs are lower than the debt itself. Now, that means China today is just swimming in debt, and you'll get massive, because they want to print those high GDP. It's got to come out of some place, and the easiest place to print GDP is by investment. And again, we don't recognize non-performing loans, so that's the quickest and easiest way to pump up the GDP, hit their targets. But it's non-productive. That means debt grows, and we have seen in China the largest and most rapid growing debt probably the world has ever seen. And this was easy to predict given the structure of their economy. And what is interesting, so a lot of people are now saying, okay, again, when I was saying this maybe 5 years ago, people were saying there wasn't much debt because they were looking, I think, in the wrong place. But now everybody recognizes, all right, there is debt, but we can get our way out of it. Grow your way out of it. Usually they're going to grow their way out of debt. Well, turns out this is very difficult. It's so difficult, in fact, that there are no countries in history that have done this. You will not find them. I mean, and I've looked. You don't grow yourself out of debt. Now, and there are many reasons for this. So often the more productive and efficient you get, the harder it becomes for some perverse reasons, but we won't go into that. So you won't grow out of debt. That is not the answer. What you need is, and just back to the point, debt. So a lot of people believe you can monetize the debt. So because there was a sort of an incident, shall we say, in the Asia crisis in the 90s, and similar-ish situation where the banks were laden with debt and that disappeared, but it didn't disappear. Just to be clear, debt doesn't disappear. All it did was place back to the household sector via low interest rates, i.e. the households got a much lower return on their investment, so they paid for the debt. And that is sort of this underlying theory from a lot of economists and many people, observers of economies. They think that debt can just be written off. But it doesn't. It just gets reallocated. So let me give you a quick example. You have a friend of yours, Tim, I don't know, let's say a friend of yours or somebody you know, has $5,000 in credit card bills. They can't pay it. They've been fired. They have no money. Okay. So they maybe declare bankruptcy, or they call the bank and say, I can't make the payments, and they write off the loan or the debt. They write off the credit card. Does that debt disappear? No, doesn't. So where is it reallocated?
Could be to a even just within internally? Yeah.
Okay, so first of all, the creditor takes it,
Right.
which the bank.
Yep.
Yeah? So the bank takes the credit. They take the hit. Now, do you know many banks?
Oh, I see. Sorry. So they've declared bankrupt. Sorry. Yeah. Right.
So your friend has said, no, I can't pay it. Maybe they declare bankruptcy. So the creditor has to eat that payment, right? So that comes out as a loss to their balance sheet. But guess what? Lenders don't like doing that. So what do? They raise interest rates on credit cards.
Right. And then everyone else pays for it?
So everyone pays for it. Why do you pay so much on your credit card interest? I know you don't because you pay it off early, Tim, but the reason there's high interest rates is because it's to cover for people that default.
So that covers the risk.
In other words, debt does not disappear. It may feel like it disappears to some, but it doesn't. And that's what happened to that in the 90s. So debt, if you're out there, some economists that think that you can monetize the debt and make it disappear. It does not go away. Debt does not simply disappear. It gets reallocated to one other part of the economy. And usually it's the households that take the hit.
Wow. Right. And the question I had from all of that is why are they so obsessed with making their GDP so competitive, let's say? Is that encouraging reinvestment from other countries?
No, I think it's a good question, but I think the quick answer is GDP. High GDP is sort of a proxy for good employment. Okay, so to keep the populace happy, you need high employment or low unemployment. And a great way to do that is to print GDP. But I think there's also ego in there somewhere that people don't. Nobody wants to hold as a politician. And certainly for Australia, in the West, we don't want to be holding a recession. So we'll do anything to avoid that. And we do a lot of shenanigans over here to manipulate the GDP. Which I guess we can cover soon. But so that's why they'll do almost anything to keep the GDP at their target.
So it's interesting that they are then kind of fudging the statistics for themselves. It's not to prove to anyone else. It's that they're...
So it has real world impacts, right?
Yeah.
The real world impact is that it keeps people employed.
Yeah.
But at the cost of something, which is high debt.
Yep.
Yeah. Crazy. So, but it also has I think a political element. You have to go out and say we're no longer hitting 6.5%.
Yeah. See, from my perspective, China has a lot of production. They make a lot of things. So is that employing a lot of people? Doesn't that automatically? I mean, you would imagine that because they're making so much stuff that they would be able to just employ people anyway. Yeah,
and I think this is potentially another misnomer is that China has a competitive advantage is that it's got a highly disciplined, cheap workforce, right? And I think that we all feel that. It feels intuitively correct with 1.3 billion people that they've got cheap labor and they've got discipline and they'll work very hard. Now, this is all true, but it's not the reason for their success. Their success is because of cheap capital. So they employ cheap capital, and that's what makes their widgets and output so quick.
Explain that just a little bit, just so I can.
Okay, so as I said, the way they structure their interest rates means that they're any money that's placed in bank accounts by the population, by the household sector, is effectively giving money to the producer sector. They get loans effectively for free or very, very cheap.
Right.
And they use that money to produce widgets. They produce it on a global scale with a devalued currency. So they've got a lot tilted in their favor, but it's all capital based. I didn't mention there anything to do with people. It was all of the capital structure.
Okay, but is that not the people's choice to save their money? Sorry, am I not interpreting that correctly?
So people need to save money. They put it in the bank account. They've got no choice where they put the banks, right? All banks are effectively state owned.
Yeah.
the state sets the interest rates they
Right.
get paid. It's very low. The interest rates whereas very low for what it should be given inflation. The returns are very low. And effectively, when a producer like a widget manufacturer or a company that's building real estate or investing in an airport can borrow that money effectively for very, very little.
Wow. So in a kind of roundabout way, the people that are earning money from building things in factories are giving their money back to the factory makers to build things.
Well, it's another way for cheap capital is an underpaid workforce.
Yeah.
Right. An underpaid workforce gets smaller and smaller share of the GDP that's produced, and more of that money then flows out of the household sector into the producer sector, and it just goes around. That's why we've got an incredibly unbalanced economy. So if you look at the most of the West, you're talking somewhere between 70-80% of the economy's consumer base. And in China, it's in the 40s or even lower. Got to mid-30s, which is just mind-boggling. I just can't believe have seen such a low number. Certainly the lowest in history.
Wow. That's that really kind of explains. So that would be a function of the communist side of their society. Would you suspect, or?
Yeah, well, yes and no, because it's the exact same model that Japan implemented.
Right.
It's like, and this is why I find it a little bit surprising that people are surprised by this, because it's the exact model. The only difference is it's probably a more muscular version of it, right? It's exactly what Japan did, and with the same outputs, the same inputs, the same results. Everybody was stunned with Japan, right? Late 80s, maybe 1990, before the bubble burst, Japan was overtaking the world, right? It was 20-ish + % of the world economy, the global economy. It was everybody was absolutely certain it was overtaking the United States as the largest economy in the world. It was unbalanced, but people said that's great because when the consumer comes on board, they'll be taking over 30% of the global economy.
Yeah.
And of course, it's not how it works.
Yeah. They're back to 7%.
And they did the round trip, which we've mentioned before. They went from 7% of the global economy to 20 back to 7. And this should be extraordinarily shocking to people, right? It's like an economy did this round trip. Extraordinarily shocking. But people just walked on into China and now saying the same thing as if Japan didn't happen.
Yeah, right. That's interesting. So there was a trigger in some respect for...
Well, the trigger is debt servicing costs. So you
Yes.
get to you get to the point where the debt servicing cost just becomes overwhelming, and I don't think you get you don't necessarily get an event. When people say the bubble burst, but that's a 3-decade bubble, right?
Yeah.
3-decade bursting. You tend to get a bursting in the West, where it's messy and problematic and painful, and it's over in a year or so.
Because it seems to me that an event could be this Trump trade war thing. I mean, that seems to be fairly threatening to this whole model.
Yeah, so I've seen a lot of articles saying who will win the trade war, and I find this quite amusing, but maybe not amusing, but interesting, because it is, look, China... It's very clear, and history is very clear on this. In a trade war between a deficit country and a surplus country, the surplus country loses, and loses badly. And the reason is because the surplus is there for a reason, and the surplus means that, by definition, their economy cannot absorb what they're producing, because there's the surplus. And they are requiring the rest of the globe, usually majority of the United States, but they're requiring the rest of the globe to soak up that production. And that's how it keeps China's economy spinning and moving. If the United States stops doing that by putting in trade embargoes or whatever, trade impositions against China, well, that sort of absorption, I call like a shock absorber to the Chinese economy, which is the surplus, disappears. And that means, well, what do you think that means? That means China needs to have more debt to be able to keep its GDP. And by the way, massively more. So the surplus is an incredibly important part of China's economy. It's very dependent on a surplus. And it cannot afford without massive debt, which has already got massive debt. Anything that lowers the surplus. Now, I think we've mentioned before, the reason that a surplus exists is because China pushes capital into the United States capital account. This forces a deficit in the United States by definition. It's not a theory. It's not a economic perspective. This is an accounting identity. It's like gravity. We might not like it, but it exists and we must live with it. That's an accounting identity. So every dollar China puts into the United States capital account by buying government bonds or investing in the stock market or putting money in anything in the United States, it's boosting up the capital account and producing, again, by definition, a deficit in the United States current account.
Is Trump then is he doing the right thing? Is it in America's interest to kind of not kill, but send China on its return flight?
Yeah. So what Trump is saying is, what he's saying is correct, and that may upset some of my more liberal friends, but he is absolutely correct that the United States has been getting a raw deal in the trade. The world trade, not just with China, world trade. I mean, one of the worst offenders out there for this is Germany. The amount of surpluses coming out of that country is absurd, and it's very problematic for the global economy. And of course, the biggest absorber of surpluses is the United States. So yes, the USA has been getting a raw deal because the global economy is dependent on the United States being in the center of it, and that is not good for the United States. Now, a lot of economists, and many of whom I even respect, say that the United States is in a particularly advantageous position because it's the reserve currency, and I'm like, no, it's the exact opposite. It's in a very bad position because people, countries like Germany, countries like Japan, and China use the United States to absorb their capital, to absorb therefore their surpluses, so that the United States can be the buyer of last resort. And the reason is because the United States is the largest global economy with the most open, flexible, and deep capital markets. So it's an easy target. So yes, Trump is correct. The United States is at the center of global trade and has been getting a raw deal. Now here's the problem. That was fine when the United States was 50% of the global economy back in the 1950s, or certainly when the Bretton Woods Agreement was put together. Now, the United States is a far smaller part of the global, still the largest, but still a far smaller portion. The rest of the world's become
important.
Wealthier,
yeah.
Right? And this is great. This is very good. But the United States still is expected to be the shock absorber, still expected to be at the center. And what Trump's saying is, not so eloquently, perhaps, but he's saying, no, this is a bad deal. It is a bad deal. The United States has to, and it will, ladies and gentlemen, it will remove itself from the center of global trade. It will do it either messily or it will do it cleanly. I don't know how it will do it. I'm a little surprised it's happening so quickly. And that's exactly what we're seeing right now.
People seem to think that he's not really doing much at all.
Well, so that's my other theory why I wasn't ever worried about Trump as a president, and perhaps I was on the more the positive side for the exact opposite reason for a lot of pro-Trumpers. So the people that are pro-Trump seem to fall into this category. Maybe I'm misreading this, but they certainly, from the people I know here in Australia that are pro-Trump, is he's a businessman who'll get things done, and I see him as the exact opposite, right? And that's what I want. I want somebody in the White House at this stage of the economy. So again, let's step back. The United States is seen as a country, but it's probably best seen as a federation of states, of 50 states that operate relatively independently until the federal government interferes. Now, the stronger the federal government, the stronger that they interfere, the more problematic that is for the I think, for the US country as a whole to proceed and become an economic powerhouse. Now, what I'm seeing with Trump, my expectations, certainly when he was elected, was that he wouldn't get things done. And that's what's happened. He hasn't got much done at all. There's chaos in the White House. And every time I see chaos in the White House, I'm absolutely fine with it. And in fact, if you look at one of the only things Trump has got done, which is the tax break,
tax
is like the only thing I can see is an awful thing to do.
Okay.
It's very bad for the economy.
Right.
It's gone straight into the pockets of the wealthy, which again just puts the more imbalance in a world which is in an unbalanced world, which is seeing too much capital and not enough money going to, in a low demand economy. You don't want it into the money into wealthy people's hands, because they spend a smaller portion than do the poor or the less well off.
But I mean, is it not meant to incentivize more work in a country that taxes less and therefore more productive countries? So I mean, that's always been what I've been told about.
I think about taxes as demand distribution rather than incentivization. I don't see that at all.
Okay.
So it's just where you want to suck out the demand, and look, and we really need more money entering into the economy. So if you just think about that. You've got 5 people in a room and one's a billionaire. If you gave, let's see, $1,000 into that room and you gave it all to the people with no money, it would get spent. If you gave it to the billionaire, nothing, it would just disappear, wouldn't it?
Yeah,
he would spend no more of that $1,000. But if you sent it to somebody that's, let's say, the other 4 out of those 5 were students, it'd be spent very quickly.
So that's why Kevin Rudd, an ex-Prime Minister in Australia, his global financial crisis mitigating $700, I think we all received. What was that called?
Yeah, I didn't receive it, just to be clear.
Oh.
I wasn't in the country by that stage.
Damn.
I
was too young, so.
Oh, right.
Yeah.
But yes, that's the way to do it.
Give it to all the poor people. Well,
yeah,
not the
yeah.
poor people,
So I was always positive Trump.
Mm.
I thought the only thing that would get done was an investment boom in the United States. And an investment boom in the United States has got to be the closest thing to a free lunch possible. It would be one of the best things to hit the global economy. And we haven't done it, which is unfortunate. Right. But what is fortunate is not much getting done. And so then I read, and I all people that are very pro-Trump, and they talk about how awesome he is for getting so much done. I know Trump says he's getting lots done, but I don't see it, and I'm thankful for it.
Yeah.
By this stage, George Bush has entered into 3 wars and done all sorts of things.
I've mentioned that to a few of my liberal friends. They don't seem to think the same thing as me, but this is more of a social point, is that by a measure of an American president, which is how many stupid wars they enter into, he's done incredibly well.
It's fantastic. Yeah.
Everything that you could have expected to go wrong has
we honestly
not yet.
We cannot be upset by words. We shouldn't be. Let's be upset by output. It's much better to have bad words than several wars. We're not even close to a war.
Yeah.
And so just look at the output. I don't want to see. And I've also read, so I don't follow politics very closely, and that keeps me quite sane. But I understand there has been significant rollback of regulations and let's call it just generically as red tape. This is also a good thing. So so I want to see less. I just want to see a lot less.
Right. See, I didn't have that impression of you. I thought you were a big government kind of man. But you're a small government. Libertarian?
No.
Okay.
No, I'm all over the shop, I think. But
sorry, I shouldn't try and label you.
I do believe that a lot more the tax system should be completely overhauled. And sending money to the wealthy it's an economic disaster.
Right. There you go.
Not going to help anyone. Anyway, so back to Trump's trade war. So he's got it right. The US has got the raw deal, China in particular, but also Germany and Japan. So, but he's doing it the wrong way. So he's attacking it through the current account, which is the trade account mostly. So he's just saying let's put these impositions and penalties onto what we're importing. This is completely wrong because it's been driven by the capital account, and will not have one iota of an impact on the trade. Now, it might have a small impact on bilateral trade. It's possible.
Okay.
But
as in trade for trade, as opposed
between
to
China and the United States. But if I can't buy my widget from China, I'd buy it from South Korea or somewhere else. So you can. It's it's possible that the bilateral trade between China and the United States may, quote unquote, improve, become less of a bilateral deficit, but it won't lower the deficit in the United States. But I still think even by that measure, the bilateral measure will fail because perversely, the Chinese wealthy, or what they call the vested interests, get nervous because of this trade war. And what do you think they do when they get nervous?
They invest their money. They don't want to lose it.
They don't invest. They move. They move their money, and they might invest in the United States and countries like Australia. So what they do is they
safe bets.
So they rather, because China, maybe they see the gig is up, right? The game is over, and so that's been a problem for China as capital flight. So perversely, because of this, the capital count, because as the capital count goes up, that deficit is increasing. Doesn't matter what you do. Yeah, that's exactly what's going to happen. And I think from the last deficit trade balance sheet, balance of payments, I saw that's in fact what's happening.
Right. Well, so you were saying that it's affecting US in a negative way. It seems to affect Australia in perhaps the same way, but we seem to have the same problem that maybe China does. Isn't our GDP perhaps too good to be true? Is it? It's doing well.
Yeah. So I do hear this. I hear a lot of people, particularly politicians and maybe some mouthpieces in the media, saying, "Look how well we're doing." But I mean, just talk to the population, right? We're talking about wage growth being stagnant. People are not feeling this joy. So again, as I mentioned earlier when I talk about China, so Australia manipulates GDP by two mechanisms. One mainly, which is through immigration. So if you're putting in one immigrant, they will by definition boost GDP because they have to eat, they have to live, they have to have a house. Everything they do, everything they touch has an economic impact, and that will be measured in gross domestic product, okay? Even if they go straight on the dole. So immigration by definition improves GDP. That does not mean it improves per capita GDP, and it does not mean it improves the wealth and the standard of living of the incumbents. So the other thing is sort of what you might describe as financialization of the economy. So we're getting significant cheap capital, again the same, which is cheap loans, lots of debt, and debt increases asset prices, and it makes the wealthy feel rich, and again prints a GDP. So if you look at the numbers, the most startling number I saw recently was the share of the economy that the labour market is picking up. So labour market growth, wage growth, is deaccelerating in Australia, and it's the lowest growth in the OECD, I think. And it's even lower than Germany's, which Germany's sort of was one of the benchmarks of very low labour growth. Now, what that means is if your wage growth in the labour market is lower, significantly lower than GDP, that means that the population, the household sector, is taking a smaller share of the gross domestic product than it should. And a smaller share means, well, what do you think it means? It means that a small share it means it's going somewhere else, right? So if the household sector is taking a smaller share, where is it going? So that's a question, right?
Yeah.
So think about, if it's going to another part, it has to go to another part of the economy. So in Germany, they were taking the same thing. They were taking a smaller share of the workers were taking a smaller share of of GDP. So it was just being exported into the export center. Places like BMW, Mercedes, were doing fabulously because they were taking a larger portion of.
So does that? But
the
that
economy.
money, does that stay in Germany?
It's in it, yeah.
Okay.
So part of that GDP. So if you think of the GDP as a measurement of the pie, and what a smaller section of the wage growth and share of the pie taken by the household sector, that means another sector's taking it up, right, by definition. So that's what got me intrigued. I don't actually have the explicit answer yet because I need to mine the data, but I do know that the Australian worker is taking a smaller and smaller share of the economy. So I suspect it's coming in two forms.
Interesting.
This is a suspicion. I suspect it's leaking into immigration. So if you want to know where the GDP is going, it's going into immigrants, so new immigrants. At the expense of the incumbent who's getting a smaller and smaller wage.
Yeah.
It's because of immigration. So that's one. And the second is it's going to the increasingly wealthy and asset-rich part of the country. And that's both an absolute disaster.
So that's interesting that then we have politicians who, perhaps not eloquently, kind of anti-immigration, anti-mass immigration at least.
Right.
And then there are people that seem to reject that on the basis of kind of inclusion and things like that. But perhaps what we're not, like that's what we're presented with by the media, but perhaps what we're not seeing is that there are people that are rejecting that on the basis of it's increasing our GDP. That seems like
that's right.
interest that
we're
not hearing about.
So I think the sort of the pro-immigration lobby do it on two fronts. One, it's you're seen as xenophobic for not wanting massive immigration, which is ridiculous. And the other one is that, gosh, if it wasn't for immigration, look how much they're doing for the economy, quote unquote. But that's the economy doesn't mean you're doing well, right? As we just mentioned, it means some parts of the economy. You've got to look at GDP per capita, and also again, the household sector is taking a smaller and smaller share of that pie, and that's really unfortunate. And that means our standard of living is getting significantly eroded, and our politicians are just not on board to this.
And so you've mentioned that you can either have a high debt or a high unemployment.
Yeah.
So is that what we're experiencing right now? Well, I mean, what does that mean? So are we in a state of either of those?
So in a deficit country, you have a choice between high debt or high unemployment. What that means is, so I'll just run through accounting identities, and for the folks listening, you can search for it if you like on Google, but so just trust me on the numbers. But so a deficit means there's an excess of investment over savings. Another way of putting it, your consumption is very high, or your savings is very low compared to what you have in your you've been investing. Now, it could mean that your investing is very high, but generally that is not the case. And anyone in Australia will know that's not been the case. I think that we're doing a lot of catch up, but we have not been investing, certainly not per capita. So that means it has to change the savings ratio, or the savings in comparison to investment. So savings has to go down. It goes down by consumption going up, and that does that by either debt increasing. So you have increased debt because debt funds consumption, or you have unemployment. Now, unemployment increases consumption, and this usually is a bit of a shock to people because it is counterintuitive. But an unemployed person continues to consume, albeit smaller amounts. They consume, they've got to eat, they've got to house themselves, but they produce zero. So an unemployed person produces zero. And you really have those two choices. You have no other choice. You either increase your debt or you increase unemployment. That's what a deficit will do to you. That's why deficits are bad. Oh, well, a level of deficit is bad, an unmanaged deficit. So we are in that place, and I think I wrote an article on this, that we've been accepting larger and larger amounts of debt. But since the Royal Commission and some tighter lending standards and all of these things. I was very suspicious that debt might not grow as fast, and that means we'll flip to higher unemployment, and that does appear to be happening to some degree.
Well, it seems tied to this trigger of higher interest rates. That's gonna produce some.
Just to be clear, that the higher interest rates are because. So the higher interest rates on home loans are not because of what the government sets. So the Royal Bank of Australia sets the interest rates, the flat interest rates, or the rate of funding. But the banks have about 30 or 40% of their funding is from wholesale funding, which they borrow through New York or London, mostly through London, via New York. And that's wholesale funding wants a return for their investment. Their funding costs are going up. They're going up because the Fed is raising rates, and those will have to be passed on to Australian banks, and the Australian banks will have to raise rates. So
that doesn't actually come from anything about our GDP.
No. So the Fed raising rates will, despite what the RBA does, increases the cost of funding for the banks. Now the bank has two choices. It can eat it into profits, so it takes a hit to P&L. Banks don't like doing that. So they will pass it on to the consumer. And guess what? That has an impact on debt. And we're looking more and more like the switch again from high debt to high unemployment.
Wow.
So that's another squeeze.
Okay, so and then those two forces are happening at the same time, and they're all multifaceted. That's very scary. But I'm sure there's some light at the end of the tunnel. Maybe we can talk about that another time.
So in one of my articles I wrote, there are a number of scare patches, but one of them is very clearly to look at our capital account. And we got a little bit of a problem there because of our addiction to debt and our addiction to mortgages and our one-trick pony banks, which just lend for mortgages.
Yeah.
And that means we're, like I said, 30 to 40% of banks' funding is from wholesale markets. So we are importing capital at pace, and that causes deficits, and deficits cause debt or unemployment.
Yep. Well, thank you. This has been a highly informative session. I'm sure all of our listeners will feel exactly the same way. Thank you for coming in today, Paul.
That's great, Tim. Thank you.
This is Currency Affairs.
Are you a podcaster? Maybe you've got that big idea and you're looking for a network to join. The multi-award-winning Ozcast network can get your content to eyes and ears all over the world. Join now for the first month free, and you could be featuring this sound at the beginning of your podcast.
Ozcast.
Simply head to ozcastnetwork.com for details.